you grew Reliance Mutual Fund 100 times in less than 22 years, right? So what is the one or two big takeaways from your journey there?
One is you have to be lucky. Lucky in the sense, I think we are all lucky to have been born and working in India at a time when it is growing so fast. Yeah. The other thing is you have to have confidence in the country you're investing in the asset class you're investing in. So unless you're optimistic, you will never be invested for a long duration of time. Now things will happen in between. There will be so many instances. I remember during Lehman, index fell by more than 50%. The fund which you're talking about fell by 65% in a matter of like 3-4 months. But it was a one-off kind of a thing. COVID was a one-off kind of thing. So I think you have to be, as I said, confident on the economy, confident in the market. And then you have to do things in a manner where you can hopefully create wealth over a period of time.
When you are looking at IPOs, for example, how do you at that time assess what is the depth that they have, for example?
IPOs are difficult, frankly, because I always give this example, of Bollywood movies. So you know that Three Idiots is a great movie, but how many times will you see it? So existing blue chips are like that. You get bored of it and you want some new movie. It's going to be a not so great movie, but still you want to see it. IPOs are like that. You don't have a history.
Right.
You have to believe the management at face value. You have limited information of the past. So we are very cautious as far as IPOs are concerned, particularly at a time when IPOs are not coming cheap.
$1 million question for a lot of investors is when to sell. Any thoughts you have on that?
We have a stated policy, 3 main reasons why we'll sell. One is something we bought has moved up far beyond its reasonable fair value. Far beyond. Second is if we realize that it is not working out. So then there is no use of retaining that. Third is capital is finite. If you come across something which can give you significantly more returns than what you already have, then you will want to switch.
One market myth that you'd like retail investors to stop believing?
You will make 25% return in equity markets every year.
Yeah. Hi everyone, welcome to Groww. I'm Radhika Bajaj. My guest today is one of the most admired and trusted fund managers in the country. As the co-founder of Abakkus Asset Manager LLP, he is currently overseeing 38,000 crore rupees and he runs one of India's most respected boutique investment firms. In fact, he is so well known for his knack for spotting opportunities and creating wealth for his clients. Now, earlier, he was the CIO equity at Reliance Mutual Fund, and he was the mastermind behind the iconic Reliance Growth Fund, which, by the way, gave a CAGR of 20% for over 2 decades. Now, any investor will know that that is no mean feat, and which is why our guest today is one of the most admired and most trusted voices in the world of investing in India. Let's welcome Sunil Singhania, the co-founder of Abakkus Asset Manager LLP. Mr. Singhania, this is the conversation that we have really been anticipating. So thank you so much for giving us time.
Thanks for having me. Really a pleasure.
Wonderful. So I think congratulations are in order. First up, you've got regulatory approval to start your mutual fund business. And there is already anticipation around that. Your reputation is legendary. But for you, was there a particular reason you wanted to get into this space?
So, see, when we set up Abakkus, frankly, in 2018, obviously, there was, I would say, a purpose behind it, an opportunity behind it. But at that point of time, I think the opportunity was looking at the overall scenario. Like in US, you have the retail moving to the mutual funds of Vanguard and BlackRock, and the smart HNI money trying to look at portfolio managers who are niche. I think that was the objective. Obviously, we grew as an economy pretty rapidly. As an equity market, post-COVID, there was a huge sort of a surge, and we did slightly better than others, so we grew faster. I think this transition to mutual fund is also taking into account the regulatory, I would say, flexibility and new product launches which SEBI has been allowing. So SIF, which is a special investment fund, is one. Obviously, mutual fund as an asset class has grown quite significantly. So, like, chalte gaye, or, things have, fallen in place. So we are also very excited, and hopefully, we'll try to do a good job of it.
I'm sure you will, but it's also a competitive landscape. आपने BlackRock की बात करी. We know that Geo BlackRock has entered this space as well. So how do you think that besides your stellar reputation, how will your products be different for investors?
No, I'm very sure. You mentioned about Geo BlackRock. They are the largest of largest. Reliance is largest in India. BlackRock is the largest in the world. They have 11, 12 trillion dollars of assets. And then, you have the ICICI and HDFC and Kotak and Axis and Nippon and so
Busy
many
space,
others.
right?
But see, if you look at the overall landscape, the equity side is 40 lakh crores as far as mutual fund is concerned, actively manage equity and hybrid funds. Our view is that even if as equity markets, we end up giving 12% return, and with some inflows, I think this 40 lakh crores will become maybe 90 lakh crores in a matter of 4-5 years. All we need is 1% to be a 1 lakh crore equity house. And 1% is if you are okay. If you do well, then that one can be 2 also. So I think there is opportunity. At the same time, obviously, we don't have as deep pockets as these guys have. We don't have as many branches as any of the banks would be having. But I think that is also an opportunity because, things are changing, everything is moving digital.
Yeah.
We believe that we will focus on pull rather than push. And pull comes from obviously a little bit of past, experience which investors have had. Pull also comes from systematic way of outperforming. And pull will also come when we start to be a little bit different. So let's see, we'll try our best.
Okay. Now, when we talk about your portfolio management services and your AIFs, they are sort of known for high conviction, concentrated bets. Is that the philosophy that's going to continue with the mutual fund products?
So it's early days, but obviously the philosophy of picking stocks, investing is a firm philosophy. It is not that for PMS it will be different and for AIF it will be different and for even private equity we follow the same philosophy, and for the mutual funds also it will be similar. The only thing, the vehicles are different. So, mutual funds, small sums of money, investors are also looking at near-term performance other than the long-term performance. You have slightly more stocks. You have to manage risk because these are small investors of 1,000, 5,000, 10,000 also. On the AIF and PMS, we are dealing with large, sophisticated investors. We can take that much higher risk. But yes, the philosophy which we stand for, philosophy is we want to be investors, not allocators. I think that would continue.
That's a great differentiation, investor, not allocators. What I want to understand, sir, is that, there is a sense that pehle returns possible thi, but now the market is much more efficient. So getting that alpha is very challenging. Is that something you agree with?
So, markets will obviously mature as the size of the economy grows. Markets will also be different in different phases of life cycle, So the same thing was true even 5-6 years back. And then COVID came and there were a lot of alpha making opportunities. So it is upon you whether you're prepared in this volatile world and whether you have the conviction that ultimately this country is going to grow to 10, 12 trillion dollars and whether you can pick good businesses, good stocks at reasonable valuations. I think if you are confident of that and you are focused on that, then alpha will be created. Obviously, the alpha which was created last 5 years of 10-15% CAGR, that is not going to be there. But even if you're on a systematic basis able to create a 3-4% alpha, I think over a period of time, it adds a lot.
Absolutely.
So I used to manage the Reliance Growth Fund earlier in my earlier avatar. I think the alpha was like 5-6%, but it became 100x in 21 years.
Correct.
Vis-a-vis the benchmark.
CAGR,
Yeah, vis-a-vis the benchmark, which was 20x. For 5-6% alpha, the difference can be really huge.
Absolutely. I think that's what has sort of earned you the reputation of, being so credible in this industry. I also want to talk about the macro, situation right now. The GST rate cuts have come in. Obviously, good for consumption when it comes to India.
No, I think any stimulus is good. So two, three things. One is we already had a stimulus by way of lower income tax in the budget which went by, which started being applicable from April, which was almost 1 lakh crore.
Yeah.
And predominantly the salaried employees benefited out of it. So 8,000 crores per month, we are already getting that benefit. Obviously, this GST announcement has multiple, I would say, positives. One is it simplifies the whole ecosystem. So instead of having 4 or 5 different rates, you primarily now 2 rates and one the syntax rate. So it simplifies and clarifies a lot of things. Second, obviously, if you have a 1 lakh crore gross benefit, that 8,000 crores a month additional will be saved by Indians. And we also have a scenario where it clearly points out that the government is listening and the government is willing to act to ensure that the economy continues to show a 7% plus growth. And if you now actually see, with this interest rate cuts which RBI has done of 100 basis points, and we presume that they are passed on, then on the EMI side also there will be another saving of 50,000 crores a year. So now we are looking at like a 2.5 lakh crores of lower outgo on an annual basis from Indians, and that definitely will spur consumption and obviously multiplier effect. So it will lead to a higher GDP growth also.
So of course, the GST Council and the PM had indicated that these cuts will come, but some are also seeing it as a reaction to the tariff situation right now. And the fact that a push was needed, given we're looking at somewhat of a dent because of the export situations. What is your mindset right now? Because there is a lot of ambiguity. We don't know what kind of tariffs will apply. 3 months down the line even, we don't know if pharmaceuticals, for example, and electronics, for example, will remain exempt. So in a time like this, how are you thinking?
2, 3 things. One is obviously, because of the timing, we can say that maybe it was also a reaction to tariff. Maybe, I don't know. The government has said it is not, but maybe, some part of it might be. But, it was announced on August 15th, before the 50% tariff was applied on India. So I don't think that it will be fair to say that it was primarily because of that. Second is on the tariff front, it is not the end game, right? Mr. Trump has been known to do yo-yos more often than not. And unfortunately, India has been on his, I would say, firing line for whatever reason. I don't think it is economics. It is more politics and ego. But it can turn also pretty fast. Our base case scenario is that it's a matter of time before India gets treated, the way it should be treated with a good relation which it has had with the United States. So we are not unduly worried about tariff lasting for an infinite period of time.
But one reaction has also been sort of warming of ties with China when it comes to trade and as well as diplomacy. Do you think, again, for Indian businesses, there are opportunities there, or should there also be concerns?
I don't know. Politics is very funny. Kal ke dushman, aaj ke dost, and aaj ke dost, kal ke dushman. So you never know. Obviously, they said it is posturing. If your friend treats you the way you have been treated, you will try to, reach out to those who are not so close. And I think that is what has happened. And I think it's a signal also that, the world is not only dependent on one country. So I don't know how to read it because things change very, very dynamically. But the good thing is that, yes, if India and China have great relations, then India, even with good relations with US, will have one more you can say in the parlance, one more engine to fire.
Absolutely. But there are certain sectors where India has a dependence on China, whether it's, I think, API, renewable energy as well. So in that space, are these sectors that investors should be looking at or avoiding?
No, so see, even with the way the relations were, irrespective of what has been happening over the last few days, India anyway was having trade relations with China, But as is the case with any government, I think even our government is more focused on trying to encourage Make in India as far as possible. So you have the PLI scheme for API, and a lot of API units are coming up. Even on the renewable side, obviously right now you need Chinese imports. But, incrementally all government, orders mandate modules being made in India.
Right.
And now incrementally from next year, the cells also being made in India. And as the ecosystem of demand increases, then it would make sense to even make the ingots and semiconductors and so on also in India. So I think it's online of that. Obviously, if things become closer, then the trade will become more vibrant.
Yeah, but also thanks to the tariffs and the volatility around that, we've seen FIIs pulling out of India. DIIs are making up; they're supporting the markets well. But at such a time, should we be looking at the movement of FIIs, what they are doing? Is that something investors should be watching
No,
out
I
for?
think FI is a crucial and important element for Indian equities and Indian, I would say, the economy also. We are capital starved, so we need external capital. So to say that we don't care about foreign flows will not be right. At the same time, in the near term, these kind of things will always happen. So they are also investors. They also look at the world. And on a relative basis, one country might be better than other country at different points of time. So if you actually see 2014 to 2024, India in dollar terms made 130, 140% return. China in the same period was zero. Emerging markets was maybe 5-10% returns. So obviously it made sense at some point of time, and given the valuation difference, to move some money out of India and into China. And I think that is what we have been seeing from October onwards. In between, there was a resurgence of interest in India. But, India-Pakistan happened. I think that caused a little bit of risk off from the country. And then as we were warming up after that, the tariff thing happened. And now again, it's a couple of months. Investors want to wait it out. But the pace of selling has slowed down. So our view is that, once things get sorted out, I think we'll start to see interest resurging. Already, we are growing at 7.8%.
Yeah.
Even if you say that that was a one-off and we'll grow at 6.5-7%, India would be the fastest growing economy in the world. We have seen the government act. We have seen our central bank act. Inflation is low. Interest rates are in check. So I think all the ingredients are there. I think it's a matter of confidence returning.
But have you been surprised, or should I say also encouraged by the inflows when it comes to DIIs?
No, I think that is all because you, me, everyone can see that India is the place to be in. There's awareness of the fact that India has growth potential. There's also awareness of the fact that equity has to be a portfolio allocation in everyone's thing. And people have also understood that you can't look at it on a day-to-day basis. So I think investors are willing to take that 3-4 year call. And I think therefore this money coming in through the systematic investment route, I don't think is going to slow down.
Okay. I want to move back to your incredible years at Reliance and, that one iconic fund that you masterminded, which was the Reliance Growth Fund. And I think you grew Reliance Mutual Fund 100 times in less than 22 years, right? So what is the one or two big takeaways from your journey there?
One is you have to be lucky. Lucky in the sense, you also, I think we are all lucky to have been born and working in India at a time when it is growing so fast.
Yeah.
So that is there. The other thing is you have to have confidence in the country you are investing in the asset class you are investing in. So unless you're optimistic, you will never be invested for a long duration of time. Now, things will happen in between. There will be so many instances. I remember during Lehman, index fell by more than 50%. The fund which you're talking about fell by 65% in a matter of like 3-4 months. But it was a one-off kind of a thing. COVID was a one-off kind of thing. So I think you have to be, as I said, confident on the economy, confident in the market. And then you have to do things in a manner where you can hopefully create wealth over a period of time. So discipline should be there. You have to also see that you don't make too many mistakes. You'll always make mistakes. So a lot of those ingredients are there. And obviously, you need to have proper processes and people to support you.
I would love to understand that, when there was a time when there were next to no returns from the Indian markets, I think between 92 and 2004. Was that a time where your confidence was shaken, or were you validating yourself and the
So I
choices
think,
you were
Radhika,
making?
it's not the right way of looking at things because, 92 was a artificially inflated market during Harshad Mehta time. So you're taking that as a base. And then you're comparing it with 2003, which was the rock bottom, the global recession post 9/11. So you're comparing one very exorbitantly overvalued market with a market or a period where it was like everything was dead. So it's not the right way of...
I'm trying to understand how you were thinking at that point.
No, but between 97 to 2000, markets were booming. You had the IT boom then.
Correct.
You know, so I think it's not that you look at the Nifty and you say from the top of 92 to 2004, you don't do well. In fact, I started my equity career during that period of time. I moved into equity in 94 and I moved to Reliance Mutual Fund in 2003. So, there were opportunities. That's why you moved to equity markets, right?
Yeah, absolutely. But do you recall certain stocks at that time which were...
A lot of stocks, they were available at like crazily low multiples. And I think that is the reason why when we joined Reliance in 2003, it was an autobahn. No one was looking at them. And we just lashed into it. And within 5 years from being the smallest mutual fund, we became the largest mutual fund. Because we were optimistic. And we were looking at things in a positive frame of mind,
Okay. But you did mention that there are many learnings from there. But was there also a mistake that you...
Multiple.
So share that with us, please.
I think, I don't know how many mistakes will I be able to share in such a short period of time. See, the thing is, everyone evolves. Human beings evolve, professionals evolve. Investors evolve. We have also evolved. When I joined Reliance, Madhu was there. I think none of us had a fund manager background, which was good because that's why I said, that's why we were positive. Those who were in the fund management and those who had seen the brunt of it, they did not even have the courage to do anything. But when you grow, on the way, you make a lot of mistakes. The only thing is, I think as a progressive investor or a professional, you have to ensure that you don't repeat those mistakes. And I think the moment you have that frame of mind, your mistakes will keep on getting lesser and lesser.
So, कौन सी एक mistake है जो आप नहीं करते हैं?
बहुत mistake है. Like in 2006-07, the easiest thing to get was capital. The global markets were booming, so any company could raise any amount of capital they needed. So I think that time we believed that this will continue forever. So we bought into a lot of stocks which were high capital intensive. And when Lehman happened, there was no capital available, or capital had become so expensive. So you learned the mistake that, in a portfolio, you also have to ensure that you don't take too many stocks with a very high debt equity kind of a thing, There are mistakes which are not necessarily a mistake, but obviously, where the hypothesis which you had thought about when investing in a stock does not come true. There are mistakes where you are a little bit slow in investing or a little conservative in investing, You could have invested, but you were overthinking. Biggest mistakes are when you sell something very, very fast. I think that is the most, I would say, hurting mistake. Because you had that stock in the portfolio and for whatever reason you sold it too early.
Yeah, I think that is one thing we always hear, that you have to have the discipline and the patience to hold on
to it.
So if we move from that time now to 2025, and I have a little bit of a quote that came out from an Abakkus communication, which says that markets will remain very stock specific, where any earnings surprise will get rewarded. IPOs and secondary market offerings continue to absorb liquidity flows and are a headwind for any liquidity-driven up move. We believe the markets are headed for a near-term phase of consolidation. So this is the memo, I think, that came out from Abakkus. And in this context, what is your advice to investors? And is it time to sort of wait and watch, like we were discussing, or exit portfolios?
So this was in July. As a fund house, we believe that buying equity is becoming a partner in the company. And we would like to become a partner in the company which is making profits and with its profit growth. So we don't invest in loss-making companies.
Yes.
And we have seen that if a company keeps on sustainably reporting good profits, it's a matter of time before they get rewarded. Post that, I think in the first week of August, we became very constructive. So we have been slightly, I would say, cautious last 1.5 years, but we have become constructive last 1 month. And that is despite the impending tariff issue which was there, because our view is that over the last 12 months, we have seen multiple headwinds, multiple small wars, slowdown in economy, huge currency movement, and then on top of it, tariff. But I think most of it have sort of got sorted. So, RBI has pumped in so much of liquidity, interest rates are down, wars in the world except Russia and Ukraine are settled. You have government which is infusing a lot of liquidity. Now, the only thing which is remaining is tariff. And that is also a matter of time. So in July, we were cautious, but first week of August, we started to get constructive. But coming to what you quoted, I think we are very clear. We will buy companies where there is profit and where there is visible profit growth.
Now, when you are investing in startups or early stage companies, how can you at that time understand the depth of the management? And this is going to your
We don't invest in early stage companies.
Okay.
We don't invest.
Okay. But when you are looking at IPOs, for example, how do you at that time assess what a company's management is, what is the depth that they have, for example, right? And this is sort of going to your meets criteria, which I do want to talk about as well.
So IPOs are difficult, frankly, because I always give this example, of Bollywood movies. So that Three Idiots is a great movie, but how many times will you see it? So existing blue chips are like that. You get bored of it, and you want some new movie, even if it's it's going to be a not so great movie, but still you want to see it. IPOs are like that. You don't have a history.
Right.
You have to believe the management at face value. You have limited information of the past. And I think the way investors are investing, you meet once for 1 hour and you take a call of investing. So we are very cautious as far as IPOs are concerned, particularly at a time when IPOs are not coming cheap.
Yeah.
On paper, they are growing 5 times the speed at which the listed companies are growing. And I think you have to be cautious. And in fact, the late stage private equity fund which we have launched, there also we follow the same principle of a profit making company and visible profit growth. So there we get time to do our research because it's private, and the IPOs you don't get even time to do the research.
And there's information asymmetry, as you said.
Yeah, and you have to just depend on what the management is guiding you.
Yeah.
So I think, yes, there are some great companies which have come up for listing and great management, and in future also it will come, but it cannot be said for all the IPOs which are coming.
Yeah, sure. And I want to talk to you a little bit about the meets philosophy. To somebody who's just started their journey in investment, how would you explain that to them?
So see, how did it evolve? So when I set up Abakkus in 2018, I think the first thing we did was we had a small team. So let's get together and let's analyze all the mistakes we have made in our investing career and why we made it and how can we at least try to prevent them from occurring very regularly. And that's how this meets framework evolved. Very simple. M is management. Now, everyone says that we have to invest in good management, but what is the definition of good management? A good-looking management, or having studied in Wharton or Stanford or something?
Leagues, yeah.
For us, it's a discipline of capital employed. So any company which does not have a 14-15% ROC/ROE, we don't invest. Then the E is earnings. See, as I mentioned, when you invest in a company, you're becoming a partner in the business. You'd like to become a partner in a business which is growing. So we typically invest in companies where profits can double, ideally in 4 years, maximum of 5 years.
Okay.
The second E is event trends and disruptions. We are in a disruptive world. The way we study, the way we work, the way we shop, the way we entertain is completely changed. You can't buy something for 20, 30 years and forget about it. And I always give example of newspapers. The advertisements have shifted to the digital platform. Or even our entertainment. From the Sony TVs and Z TVs and Star TVs, we have now moved to the Netflix and the Amazon Primes and so on and so forth. Or even motor cars. I think in India it's fine, but globally if you see, Tesla has created a lot of wealth. But BMW, Mercedes, Stellantis, they all traded 5-6p. Because the perception is that things are changing to the EV side. So I think that is again very important because market price is equal to EPS into P. EPS is earning, P is perception. So for the same earning, if the perception reduces, you will make a loss, as an investor. T is the timing. You can't time the market. But our view is that the best company is not necessarily the best stock. In fact, 5 years back, we also wrote an article called Bubble in Quality. Because all the quality stocks were trading at 80-90 p multiple. And our view was that a company which is growing at 5-10%, they cannot trade at 70-80 P multiple. These are great brands, great names, but not great stocks. So we do believe in the theory of mean reversion. And last is the structural bit. We are a growing economy. There will be some sectors, some companies which grow really fast. So despite our value conscious approach, there are some stocks in our portfolio where we are willing to give a higher multiple because the growth rates can be faster. So very simple meets framework, but it works.
So, coming off that, the point is that, and it's $1 million question now, how to understand if you're paying the right value, especially when it's a bull run?
It's tough. I'll be very honest. We can all say, because value is also relative. At some point of time, a 10p will be reasonable. At some point of time, a 15p will be reasonable. At some point of time, a 20p will be reasonable. At some point of time, the p might not be relevant. So a different life cycle of a company, of the country, different, environment, things change very dynamically. But as I said, ultimately, what you have to see is what you're paying. In how many years you'll get that back.
Yeah.
And if that, I would say, is relevant or it is attractive given the cost of capital, then you should buy. So if the cost of capital was 15%, maybe a 10p would be more relevant because anyway in fixed income you're making 14-15%. But now with the cost of capital having come down, it is very natural that the P multiples would have gone up.
The other $1 million question for a lot of investors is when to sell. Because there is a lot of a lot of research that goes into how to buy, when to buy, but when to sell is also an art. Any thoughts you have on that?
We have a stated policy, 3 main reasons why we'll sell. One is something we bought has moved up far beyond its reasonable fair value. Far beyond. Not 10-20%.
But that is also subjective.
As per us.
Okay.
Yeah, subjective means as per our analysis.
Got it.
Second is if we realize that it is not working out. So then there is no use of retaining that. Third is capital is finite. If you come across something which can give you significantly more returns than what you already have, then you would want to switch. So it's not that the company which we have in the portfolio is bad, but something else for the same sum of money you can buy which can possibly give you higher returns. So these are the 3 main reasons, And then there are others. Sometimes you try to buy, you are able to buy only a small quantity and the price runs up. So you don't want a tail, so you sell it off. Those are like, I would say, chiller reasons or ancillary reasons,
Do you believe in holding on to cash when the market is volatile, or should one remain invested?
So we don't take cash calls normally. But we usually have cash in the balance in our funds. That is largely because we have taken a sell decision independently of a buying decision.
Okay.
So as I said, if we believe that this company has moved up far beyond our fair value, we will sell. At that point of time, it is not that on the same day we want to buy something else. We don't mind having 5, 7, 10% cash because for us, cash is an outcome, not a decision. Unless the view is that no, you have to have a complete risk off, which so far we have not encountered.
Okay.
Like Corona also, it came all of a sudden. So it's not that we anticipated Corona, and that's why we had created cash or something.
So, from your years and years of experience, are there time periods and stocks that tested your patience the most?
Yeah, I think in investing, patience is always tested. Because it is impossible to be the best performing every month, every 2 months, every 6 months. And the other thing is even on stocks. See, it's very easy for us to invest in a stock and then expect the management to deliver every day. Business is so dynamic. Now, take the example of tariff. Now, if you are an exporter of, say, garments, suddenly you are slapped with 50%. So your demand, at least in the near term, will be impacted.
Yeah.
So sometimes stocks don't perform because of external factors also. And there will be a lot of times when the patience is tested. There are some regulatory issues which come up. Like we had an NBFC where there was an embargo by RBI temporarily on fresh loans to be given on the gold side. Stock falls rapidly because of that. But then it picks up again if the fundamental is good. So multiple times you'll have that. I think that is when your conviction on the long term is tested. And the other thing is your communication with your investors. See, it's not my proprietary money. We are trustees of public money and we are answerable to them. So if your communication to your investors is very clear, then you are not under pressure to do something short term. But these things are tested every day, you know. It's not.
So now, as the mutual fund business takes off, what will success look like for you? Say 5 years down the line, what will make you feel that this was a great choice and this is a successful business?
So on the mutual fund side, it's a completely additional team who's going to take care of it, fund manager and so on and so forth. Obviously, the philosophy will be the same. Obviously, my name and Abakkus name is associated with, so there is a big, I would say, responsibility. What would make us happy is obviously to ensure that our investors are able to create wealth by being a part of the growth which India will be able to offer. And I think if we are able to do well, in terms of performance, we will grow as a company. We never have market share targets or AUM targets. I think it's an outcome.
I was about to ask, is there an AUM target?
No, it's an outcome. I think if we are doing well, then, we can be larger than a lot of other ones. So, this whole thing of, you're starting small and you can't be large or so on and so forth might not be relevant, because the pecking order in every business changes. It is on how well you are able to perform for a longish period of time, not in burst. So I think the focus would be on that only, how we can be really, really adding value to our investors.
How do you define quality? You speak about investing in high quality companies. And could you also tell us a little bit about this 5D investing process?
So I would say that, you have to invest in good companies which are good stocks also. If you invest in the best companies which are very aptly priced, then those are not great stocks. How do you determine whether a company is investable? I think it all boils down to the discipline in terms of capital deployment, which is what the M of MEETS stands for. So return on capital employed becomes very, very sacrosanct. The 5D is post the MEETS framework. So you have the MEETS framework, and then that is a process. So we have 6,000 listed companies. If you run them through the MEETS framework, you're left with 400, 450 companies. That is what we do, delve in as far as our internal research team is concerned. And then you do the detailing, and then you discover out of it 70, 80 companies, and then you basically deliver in terms of creating it in a portfolio. So it's a process, very, very, outlined process.
You have mentioned many times that you don't invest in loss-making companies, but if we look at the private equity fund, which is the Abakkus 428 Opportunities Fund, it invests in profit-making startups with IPO visibility in the next 2 to 3 years. What were some of the other key factors that sort of led you to invest in companies like Botanic Healthcare and Caliber?
So I think they qualify all our criteria. We have so far done 5 investments. We are in the process of closing another 3. Most of them, I will say all of them, are good management, very profitable, visible profit growth, maybe doubling in the next 3-4 years. And we got it at the valuation which was comfortable to us. And I think that is what we would stand for.
Can you tell us what sectors these companies are, the ones you're...
So very different. I think Caliber is a mining engineering company.
The ones you haven't signed on yet. You were saying you're in the process of
closing. One is a good platform company, but very profitable, but it's still early days. Another is a new age jewelry company. We're also talking to a building material company. So I think good thing is people feel that we will be able to add value in terms of our input, even when they are private. Obviously, we'll give them capital. And they also believe that if we are an investor and they go public, because of our past reputation, the other investors will be more than inclined to at least believe that fundamentally there's nothing wrong in the company.
Okay. I want to talk a little bit about sectoral bets right now. And I think you have been very optimistic about financials, pharma, metals. And you've also said that financials are inversely correlated to liquidity. the RBI we know has injected liquidity. Can you mention a few companies from these sectors that you've invested in, and what was the criteria for putting in
So
that
I
capital?
don't talk stocks. We are not
Okay.
allowed to talk stocks. So
Okay.
if you want to ask me about sectors, I can talk.
Please.
Yeah. So what was the question? Sorry.
The sectors that you are positive about.
So right now, see, it's the same. I think financials, including banks, NBFCs, more so non-fund based financials, which is capital market plays, fund management companies, wealth management companies. We're positive on pharma. Our view is that yes, there is a near-term news flow headwind that tariffs might come in.
Yeah.
But otherwise, Indian pharma companies are doing well, and I think the runway is pretty long and large. Chemicals, metals are some smaller companies we like. I think capital good companies have reacted a little bit. They are coming to some kind of selectively comfort zone. We would be optimistic on that. And in fact, we have also started to look at companies which have reacted on the markets, equity markets, because of near-term tariff headwinds. But a lot of them are really good companies. So maybe it's an opportunity, because at least our view is that these tariffs are not going to last forever. So selectively, we are also trying to nibble into those
Do
companies.
you have a view on IT stocks?
So IT services, we used to be positive, but last 1 year we have been significantly underweight. And the challenge there again is, they are guiding for 2-3% volume growth, trading at 25p multiple. There is a headwind from US. There is a headwind in terms of AI. I think the only near-term tailwind has been this currency, which has depreciated by 3-4%. But I would say that, incrementally, IT services would continuously keep on seeing some selling from institutional investors.
You've also spoken in the past about platforms doing well. So platforms in e-commerce, they've been loss-making, but Zomato is now...
No, I was just, telling you about IT services.
Yeah.
I think some allocation which is there in IT services will move to some of these new age digital/IT companies. We don't invest in loss-making companies, and a lot of these companies were loss-making, but some of them have started turning positive. So we are also evaluating. I think some of them will do really well.
Okay. So I have a few kind of rapid fire questions. I think the first one being one investing metric that you feel is really overhyped.
Investing metrics. Buy at any price.
Buy at any price.
It's very hyped.
Very hyped.
Yeah, I think you see what has happened in 2019-20 to now. For a company which is growing at 5%, whether you'll pay 80-90p, you won't. Yeah.
Is there also a metric that people overlook and should be paying more attention to?
Cash flows. But I think people are paying attention.
Okay.
Now markets are smart, and there are a lot of smart people around.
One market myth that you'd like retail investors to stop believing?
You will make 25% return in equity markets every year.
Every year is the catchphrase, right? Every year. Okay. Your one-line advice to somebody who started investing during the COVID times and had not seen low returns?
So we should be thankful to God that between 2020 and 24 was a dream run, but it is not going to continue forever. Going forward, the returns will be more like 12 to 14%.
Okay, basically get real, right? The one financial ratio you would absolutely not ignore?
EBITDA to debt, or debt to EBITDA. Anything about 2.5 debt to EBITDA, we get a little worried.
Okay. Coffee or chai?
Once in the morning, I have tea, and then 2 black coffees.
One personal area of discipline that you have worked on and you're proud of it?
I walk every day. And twice a week physio. And no sweets.
No sweets?
No sweets.
मुंह मीठा नहीं किया जाएगा जब म्यूचुअल फंड
मानी अभी कोई एकदम ही कुछ स्पेशल ओकेजन होगा और छोटा सा एक पीस किसने खिला दिया तो ना नहीं बोल सकते, किसने प्रसाद दिया तो कैसे ना बोलेंगे. तो गणपति के टाइम पे पूरे साल भर का मीठा हो जाता है. बट अदरवाइज नो स्वीट्स.
Okay. Books that you recommend to investors?
I think multiple books. Favorite obviously is Reminiscences of a Stock Operator. I like autobiographies.
Okay.
And the reason is who writes autobiographies and who will buy the autobiography of who? Someone who's very successful.
Yeah.
So if someone very successful writes a book, it's 25 years, 30 years of experience, you can get for 500 rupees,
Yeah.
And that experience always will give you 5-7 learnings, which will be like, you will never be able to otherwise know about it. So autobiographies, I am a big fan of.
Any other recommendations? So you mentioned one. But
I am reading What Not to Invest. It's not a great book. It tells you, like, it's a good book. Don't take me otherwise. What I'm saying is that it tells you the same thing which you know, but in a nice way.
Okay.
So because this is a market where you should know what not to do. This is not a market where you necessarily need to know what to do. You need to know what not to do because it is not cheap. If you make mistakes, it will eat into your capital.
Okay. I think final question would be about the mascot, the squirrel. And you and I spoke about why that's your mascot. And I'd love for our viewers to hear that too.
So, see, I'm born and brought up in Bombay, a very, very street smart Bombaya guy, a lot of friends. And, we have grown, the typical, middle class way. So I like to have stories in everything. So Abakkus. So Abakkus is actually the ABACUS is the actual word, which is the first counting instrument. When we used to go in KG, we had that slate with
Correct.
these bids. Modified to ABAKKUS, which is Kanchan, Khushi, Ujjwal, Sunil. So it becomes a little personalized. Squirrels I always liked from my childhood. I like to watch them. But if you actually see, squirrels are very balanced. They're very flexible. They're very active. And they're hibernating. They keep on collecting every day. I think that is what we want to be as investors. Balanced, flexible, agile, and always collecting small returns. And the squirrel keeps on reminding me that we have to be like that.
Wonderful. It was so lovely speaking with you. Thank you so much for joining us.
Thanks a lot.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.